Welcome back to Market on Close. Time for Options Corner. I'm joined now by Kevin Green, Senior Markets Correspondent for the Schwab Network, and I would say a masters of the flows, KG. NASDAQ stumbling a little bit. I mean, I'm making something out of nothing in many ways. It's still pretty quiet, but it's the most action I've seen in the last couple hours, down 40 in the NASDAQ futures.
Yeah, we did see a little bit of a breakdown here, and just a small breakdown. But if you're kind of looking at the S&P 500 overall, we're still holding up, looking at that 5,900 level. We've been keeping that on the radar here over the last couple of trading sessions. And right now, it's turned into an area of potentially support. So going into the close, what are we really kind of focusing on is that being a level that has some pen risk there. A lot of options activity, both on the call and put side, not only for today's expiration, but also for tomorrow's expiration, which will have a little bit of an influence here. But if we are able to get a little bit of a break, get out of this little head and shoulders formation that almost saw a breakdown below that neckline, which is that 5,900 level. If we are able to see a little bit of a bounce back, I'm looking at 5,920 to the upside here. Any further breakdown, 5,890, very compressed range here. I'm not looking at any type of major break going into the close, barring any news that does hit the tape here. Really looking at this consolidation. Even if we break below 5,900, 5,890 is not really a big deal in the big scheme of things when you're kind of looking at the trends that we've had. So overall, we're actually holding up pretty well.
Yeah, looking at SPX, I mean, we're hanging on just above 5,900, 5,908 right now. Probably doesn't seem completely out of the realm of possibility that this would ease its way towards 59. I mean, those big round numbers oftentimes are pressure points, right?
Yeah, they are. But they also can be, so what we've seen over the last couple of days is the progression of that level, where we've tested it and we rejected it very aggressively. We tested it again. Now we're kind of trading around it and trying to actually defend it. So you're just saying it's weakening a little bit as an area of potential resistance. And so tomorrow I think is going to be very key. Obviously going into the close will be key, but tomorrow we have a lot of options that are going to be expiring. We'll have a little bit of a reset going in over into the weekend here. And then we're going to be preparing for the quarterly options expiration that's going to happen in the third week of June, which we'll keep an eye out on. You really want to try to be able to close above 5,900. I think that would look good from a candle structure standpoint, and then also giving a little bit more sentiment for the market that they are able to really see some follow through here. Get a little bit concerned when you're looking at the sector makeup right now. A lot of it's defensive, also interest rate sensitive. We also have the S&P 500 total composite volume. If you look at the volume of all of these stocks that's within the S&P 500, we've been declining pretty much every day since Monday. And so that's also kind of, attributing to the fact that we are seeing a little bit of consolidation here and maybe some weakness, maybe a little bit of exhaustion. But for the most part, we're actually holding up here.
Yeah, you got a couple other charts here for us as well, KG. Why don't you go through what we're looking at when you pull up the rest of this? Does this help set up the rest of the week for us?
Yeah, not only just the rest of the week, but because we only have one more day left, but actually I wanted to kind of go back and revisit the 10-year Treasury yield futures that we had, that we looked at this morning here. And this is another one that's in kind of an inverse head and shoulders pattern where the yield looks like it could be trying to break out of that neckline. But what's interesting about today's candle structure is that we are actually seeing a bearish engulfing candle on today's candle if we are actually able to close at these levels. So we have a pseudo-bullish formation when it comes to yields moving higher, but we also do have a candle that's really saying that maybe trend is going to change here. So I'm actually looking for a make or break moment for the 10-year as well as the 30-year Treasury for now. And once again, I think we're going to actually have an interesting next couple of trading sessions to see where this market's going to shake out.
Yeah, it seems like we're at a really critical point for yields, no doubt. But we're also watching this rally just continue to gain, I guess, ground, but doing so with seemingly less interest and less volatility. And I say less interest because volume's kind of fallen off a cliff as well.
Yeah, so volume's fallen off well, not I wouldn't say fallen off a cliff, but it is definitely decelerating as far as the rate of change for volume. One of the biggest indicators that I've been focusing on, and we'll probably bring this back up a little bit next week, that I want to make sure that people have an eye out on, is actually credit default swaps. I brought this up a couple of weeks ago where we saw, this disjointed nature of credit default swap pricing continue to move higher, but you did see equities kind of moving lower. But you're now seeing that actually Everything is
big short. Is that what's going on?
No, I mean it's a really good indicator. I'll bring up a comp chart tomorrow, but if you actually look at the difference in the trend between the S&P 500 and what is happening in the yield space, especially in high yield credit, there's a direct correlation, 1-to-1, almost 1-to-1 there. And so it actually lingered for a little bit, but now you're seeing that actually move to the downside. And I think until you actually see something that actually forms in that credit space, I don't think that you're going to see any type of meaningful break in the S&P 500. So I'm keeping that on the radar as well.
And for those who don't necessarily watch this space as much, when you're seeing the CDX, high yield CDX in particular, start to get under pressure, then you're going to basically be saying that the recession risk is picking up?
Yeah, not only recession risk, just volatility risk. Because, I mean, we've seen a lot of fake outs when it comes to the recession calls over the last, 3 years, 4 years. But you're looking at volatility spikes and what could actually drive volatility. Right now, we actually have a volatility crush, especially going into tomorrow's expiration. We're sitting at around the 18 level. I would say this is a healthy level for right now. I would say that you're also kind of looking at VVIX or vol starting to inch up a tad bit here, so keep that one on the radar. But until we actually see something materially break within the credit space, in my opinion, and equities continue to perform in the manner that they are right now, I think everything is really giving a lot of favor to the bulls.
Well, we know one thing's for sure. When high yield gets under pressure and those spreads start to blow out, that gets the Fed's attention. Happened in 2020, and they acted very, very quickly. So if you're looking for something that would get the Fed off the sidelines and into action-taking mode, that would be something. Kevin Green, appreciate it.